Could investors soon hit the brakes? A new report from Goldman Sachs says that if the 10-year yield reaches 4.5%, stocks could plummet up to 25%. Joining us right now is PNC Financial Services Group Senior Vice President, Senior Economic Advisor, Stuart Hoffman. Also with us in New York, Benchmark Managing Partner, Kevin Kelly. Good to see you guys. Thank you so much for joining the conversation. Stuart, the 10-year sits now at 2.87%. 4.5% is a long way off, isn't it?
Yeah, a long way off. And what would get you there? Inflation closer to 4% than 2%? Sure, that wouldn't be good for the stock or bond market, but I think there's a long way between now and then, and that the stock market, goes higher because good earnings, good economic growth, and we're still struggling to get 2% inflation, not 4%.
So you would still put money to work in this market?
Yeah, PNC is still putting money to work. We put money to work during the, quote, correction. May not be over. We know there's going to be more volatility, but we'd be putting money to work. Yeah,
Kevin Kelly, I mean, I know that Goldman's base case scenario calls for the 10-year yield of 3.25% by the end of 2018, but they're still saying, should it go to 4.5%, this market tumbles. I don't know why anyone's talking about 4.5%. Is that what you see happening?
Yeah, I don't know. I mean, I think they're just grabbing for headlines in this scenario. Because
I agree.
Yeah, I mean, it's completely absurd to think we're going to get to 4.25%, especially because the inflation numbers we've gotten recently that have come out actually aren't even going to hit the 2% number that the Fed's looking for. We'll get more indication on that on Thursday when we actually get the PCE, which is the core inflation number that the Fed looks at. And Jay Powell is going to be testifying Thursday, so he'll give indications on where inflation is at right now. But you should also look across the street from Goldman Sachs and look at Morgan Stanley. Morgan Stanley is actually calling for investors to buy bonds right now because they think the sell-off is overdone and there's going to be a narrowing in the spreads between the 2-year Treasury and the 10-year Treasury. Now, getting back to the 3.25%, we've seen the market is okay with that. We had a recent sell-off. They were reassessing the risk. Should bonds go up to that, bond interest rates go up to that level? But this goes back to how the market is valued. We need to consider that basically from when the Fed did their easy monetary policies from 2010 to 2014, most of the gains were in multiple expansions. So the PE of the stock market went from 15 to 18 because the cost of capital on the debt side went lower. So these are things investors need to take into consideration.
Let's look at the backdrop here because we're getting the second reading on the fourth quarter GDP this Wednesday. That could be a market mover. Economists are expecting a GDP number of 2.5%. Over the weekend, President Trump said that he thinks we will see growth of more than 3% in the next few weeks. Listen to this.
You're going to see some numbers coming up over the next year, the likes of which we haven't seen in our country for many, many years. Your GDP numbers, as you know, the first quarter or the last quarter for the previous administration was not good. And if you look at them now, we're hitting threes routinely, and we had a 3.2, and now I think we're going to exceed that by quite a bit. We'll find out very shortly. But I can tell you definitely over the course of the next couple of years, we're going to really be exceeding it.
Stuart, your thoughts. What are you expecting from the GDP report? Give us a sense of the backdrop here.
Yeah, I mean, I think 2.5% for last quarter, not much of a revision. If anything, a little bit of a slower consumer spending. Yeah. There's always a problem, or has been, with growth, GDP growth in the first quarter, let alone that it's been a wet and cold quarter.
It's not a good, seasonally, it's not a good quarter.
Right, and the government's trying to deal with that. So I don't think we're going to get 3% this quarter, meaning the first quarter, or that we got it last quarter. After that, I think the momentum from the stock market, better consumer confidence, obviously tax cuts, and some spending gets us to 3% the rest of the year. Sustaining it there in 2019 or 2020 without a lot more productivity growth is where I have my doubt.
Well, there's no doubt that the policies coming out of this administration, guys, really spiked the numbers. I mean, you look at the rollback in regulations, you look at the tax cuts, and you actually saw animal spirits unleashed in terms of activity. You agree?
I do. You know, there was a lot of fear that corporations wouldn't use their tax cuts and bring it back to the United States, that they wouldn't reinvest in the economy, that they wouldn't raise wages, that they wouldn't give bonuses.
Exactly what they're doing.
Then that the American people would hold on to their money and not spend it in the economy, and we'd see rise in inflation. And so far, none of those have really been realized, and the corporations have been taking the money they've gotten from this administration's policies and putting it back into America.
Yeah, they sure are.
I think it's very difficult to make a case that the tax cuts have not, at least in the short term, been a huge success, and that deregulation and the promise of tax cuts did not lead to, I think, a lot of consumer confidence and confidence among large and small business owners about the direction of policy in this country, and that optimism has been rewarded.
Yeah, real quick, Kevin Kelly, your thoughts on the GDP Wednesday?
I think it's going to be a great report. If we go to 2016, the Obama administration had a 0.6% GDP in the first quarter.
Wow.
Last year, we had a 1.6%. This year, we're going to get above a 2% handle, which is great for the first quarter. And I just want to say that these monetary policies that this administration is enacting is letting capital go to its highest and best uses and not to regulatory capture. We're going to get above a 2% print.
Yeah, we're going to continue previewing what Jay Powell will say in this testimony this week. That's going to be important. Gentlemen, thank you. Stuart Hoffman, it's good to see you this morning.